there's some really peculiar things about it that if you're just starting out, you may not know. So the first thing is, when you buy cryptocurrency, that in itself is not a taxable event. You're exchanging cash for Bitcoin or Ethereum or whatever token you're purchasing. But when you use that, so let's say you purchase something with a Bitcoin or Ethereum, when you purchase that item, that creates a taxable event. And what does that mean? Well, the IRS has defined cryptocurrency or lumped it into the category of being a capital asset. So basically, it's like, it's probably easiest to think of it as if you're buying and selling a stock. So, for example, if you bought, 100 shares of Microsoft at, $100 a share and then sold it, a year later for $120 a share, then you'd have a gain of $20 per share times 100. So that would be your gain. So with cryptocurrency, it's pretty much the same thing. You have your cost going in when you purchased it. When you utilize the Bitcoin or Ethereum or whatever cryptocurrency you're using, then you have to take the value at that date, at that point in time, and determine what the gain is between that point in time and when you purchased it. It's easier if you're just selling it. That makes sense to people. Okay, I'm going to sell. I'm selling an asset. I purchased it at X value. I purchased Bitcoin at 50,000 and I sold it at 60,000. If I had one Bitcoin, that's a gain of 10,000. That's easy. But if I purchased one Bitcoin at 50,000 and then I bought, something for 0.3 Bitcoin on 3 weeks later, and then I bought something else with Bitcoin, a year later, then you have a mix of short and long-term capital gains. Now, short-term capital gains are less than a year, and those are taxed at ordinary income rates. So whatever your ordinary tax rate is, that's, if you used it less than a year after purchasing it, you're going to be subject to ordinary income tax rates if it went down, if it went up. If it went down, that's going to be a loss that you can offset against other capital gains. If it's been more than a year since you purchased it, the advantage is that the gain you make there is subject to long-term capital gains, which are 15. It can be as low as 0%, but for most people are going to be 15%, and for upper income people, it's going to be 20%. So that's the overall idea of how the taxation works.